Welcome to another episode of the Ontario Mortgage and Real Estate Insights podcast, where we keep you updated on the latest industry news, trends, and regulatory changes. I am your host, Steve Hamilton, and today we have a packed episode filled with crucial updates that could impact your decisions in the real estate market. Our first segment today dives into a topic that has been on everyone's mind. Is Canada's housing market about to roar back into life? The recent rate cut by the Bank of Canada has spurred optimism, and we are here to break down what this means for you. The last month of housing market activity before the Bank of Canada's interest rate cut at the beginning of June saw sales remain muted, with home buying sluggish in May. Recently released Canadian Real Estate Association figures showed national home sales posted a marginal 0.6% climb in May over the previous month, with actual activity down 5.9% year over year and the MLS Home Price Index dipping by 2.4%. Still, the central bank's 25 basis point cut on June 5th has revived optimism on a housing market uptick in the second half of the year, and Canadians' homeownership aspirations have remained largely undimmed. Even amid a prolonged high-rate environment and turbulent housing and mortgage markets in recent years, 62% of respondents to a recent Bank of Montreal survey said owning a home was one of their biggest aspirations in life, even if a significant percentage also viewed home ownership as currently unattainable. For Samantha Villiard, Regional Vice President at RE/MAX Canada, the continuing determination of Canadians to forge ahead with home buying plans is part of the reason for cautious optimism on the housing market outlook for the remainder of the year and looking ahead. She told Canadian Mortgage Professional that encouraging recent trends in the housing market included a jump in condominium purchase activity by Toronto first-time homebuyers. Regardless of economic pressures, the rising cost of living, those interest rates, and lack of inventory, Canadians remain positive that homeownership is a solid investment, she said. We've seen some areas like the condominium market in Toronto that saw an uptick a few months ago. So that was really positive to see that first-time homebuyers were cautiously entering the market. And those buyers have been sitting on the sidelines for a while, waiting for the Bank of Canada announcement. Buying a home in Canada became more challenging in May as rising property values offset flat mortgage rates, according to the latest housing affordability study by RateHub. How will home buyers react to the Bank of Canada rate cut? That move to lower rates, which many observers believe marks the first in a potential series of rate cuts before the end of this year, could spur more buyers to step off the sidelines and enter the market, according to Villiard. With the reduction that was made, I definitely anticipate the pent-up demand has got to go somewhere, and they're going to be ready to go now, she said. It's been itching to get started, and I feel like that was a point in the right direction. Other prospective buyers, meanwhile, may decide that one rate cut is not enough for them to step up their home purchasing plans. And with home prices in many markets also remaining steady or slipping slightly, some sellers are holding fire on listing their properties. Still, lower rates and a more active market could see sellers decide to list their properties as prices begin to climb again, potentially leading to a market that is well balanced between buyers and sellers. It's notable that with the interest rates being reduced even a small amount, when that happens, the prices go up, Villiard said. So these markets throughout the country that are struggling with inventory, the sellers are going to reap the benefits of having prices go up. I hope that points us in the direction of moving towards a more balanced market and providing that opportunity for sellers to jump into the market as well, who have been sitting on the sidelines, really waiting for the Bank of Canada announcement. While the coming weeks may be too early for a flood of sellers to re-enter the market because good weather, holidays, and other plans can get in the way, Villiard said she is hopeful things pick up on that front by the end of the summer. A range of factors could temper the Bank of Canada's approach to further interest rate cuts before the end of the year, not least the outlook of the United States Federal Reserve and its own stance on lowering rates. Nonetheless, Governor Tiff Macklem struck a positive tone in his remarks following the June rate cut, and Villiard is optimistic on the prospect of a stronger housing market in the second half of the year as the rate hiking days fade into memory. I'm really excited to see now with this announcement, people getting back into feeling more confident of entering the market, she said, whether that is the buyer or the seller. Home prices in Ontario continue to be a significant barrier for many prospective buyers, but there are still some urban regions within the province that offer relative affordability. One such area is Ottawa, which has become increasingly attractive for those looking to escape the high costs of cities like Toronto. According to data from the real estate marketplace Zolo, the Ottawa region includes 5 out of Ontario's 10 most affordable cities. Zolo's analysis considered 97 small, medium, and large cities in Ontario, ranking them based on affordability factors such as average home prices, household incomes, population growth, and unemployment rates. Among the top 10 most affordable cities, Nepean, Carleton Place, Canada, Rockland, and Ottawa were prominently featured, with Nepean taking the top spot. The average home price in Nepean is $572,388, and the average household income is $137,000, leading to a home price-to-income ratio of 6.69. Additionally, Nepean boasts a low unemployment rate of just 4.9%. Ottawa realtor Anita DeVries Bono highlighted that Ottawa and its surrounding areas are not only affordable, but also stable markets. Compared to the Greater Toronto Area, Ottawa offers a more accessible entry point for homebuyers. Realtor Matthew Mercier Burns has observed a growing trend of buyers relocating from the Greater Toronto Area to Ottawa in search of more affordable housing options and a different lifestyle. Toronto buyers are our favorites because they come in here and give us full asking, Burns noted, adding that those who sell townhouses in Toronto for $1 million to $1.2 million can find similar properties in Ottawa for around $750,000, fully upgraded. Burns also pointed out that Ottawa offers a quieter, smaller city experience with easier access to amenities. Transportation is easy. Everything is 20 minutes away in Ottawa, he said, contrasting it with Toronto's notorious traffic and congestion. For those considering a move to Ottawa, the time to act may be now. There's a saying in the real estate world that the time to buy was yesterday, Burns remarked. While the Ottawa market, like the rest of the country, has experienced a subdued period, there are signs of activity picking up. DeVries Bono mentioned an increase in new listings this spring as sellers' confidence has returned, and buyers are also starting to come off the sidelines, spurred by the recent interest rate cut. Burns added that the interest rate drop has brought back some buyer confidence, and more people are entering the market. The condo market is still very slow, but areas like Richmond, Carleton Place, and Kemptville are very active because you can get a lot more for your money there, he explained. Stittsville and Orleans are also popular choices among buyers. DeVries Bono also highlighted Kemptville, located south of Ottawa, as an increasingly desirable place to live. A lot of people are living there and commuting to downtown Ottawa with ease because the 416 highway is right there, she said. A new development by Mattamy called Oxford Village is gaining popularity, and Kemptville is planning an expansion of Country Road 42 to make commuting even easier. I think the southern Ottawa region will be increasingly coveted, she added. Demand is also growing in Ottawa's surrounding rural areas, which are affordable and offer relatively easy commutes to the city. Waterfront real estate in the region is also expected to see increased interest. This is a big city for cottaging, Burns noted. He mentioned that government employees returning to work for 3 days a week in September could lead to more cottages coming up for sale, making it a good time to buy a cottage. Regarding housing stock, Burns noted that bungalows are currently in high demand, especially among baby boomers looking to downsize. A lot of boomers are moving out of their big homes and into bungalows, he said, adding that many are also opting to rent. While Ottawa remains relatively affordable, Burns cautioned that this might not last forever. Data from the Municipal Property Assessment Corporation shows that homes valued between $500,000 and $750,000 now make up 43.2% of Ottawa's real estate market, while only 19% are valued under $500,000. Despite this, DeVries Bono believes that Ottawa will remain more affordable than other urban centers in Ontario. Ottawa has been an affordable area for a long time, she said, noting that the city has maintained stability even amid fluctuations in the Toronto market. Ottawa's efforts to increase housing supply have also been commendable. The city has been recognized for its ability to get shovels in the ground. In April, Ottawa received over $37.5 million from the Ontario government for nearly reaching its provincially mandated housing target for 2023. Ottawa is building as fast as it can, Burns added. Shifting gears now to the financial sector, Canadian bank ratings have mostly remained stable, but there is an exception: Toronto Dominion Bank, also known as TD. According to a recent report by Fitch Ratings, while most major Canadian banks have maintained strong creditworthiness, TD faces a negative outlook due to an ongoing money laundering investigation in the United States. Fitch Ratings reaffirmed the long-term issuer default ratings of Bank of Montreal, Bank of Nova Scotia, Canadian Imperial Bank of Commerce, Toronto Dominion Bank, and Royal Bank of Canada at AA. On the other hand, the National Bank of Canada's long-term issuer default rating was kept at A+. While the ratings for Bank of Montreal, Bank of Nova Scotia, Canadian Imperial Bank of Commerce, Royal Bank of Canada, and National Bank of Canada remain stable, Toronto Dominion Bank's outlook has been downgraded to negative. This change is primarily attributed to ongoing regulatory investigations in the United States concerning TD's anti-money laundering practices. Fitch's affirmation of these ratings reflects its confidence in the fundamental strength of Canadian banks. The agency expects stable economic conditions to support bank credit fundamentals and financial performance. According to Fitch's Global Economic Outlook, Canada's gross domestic product is projected to grow at 1% for 2024, increasing to 1.5% by 2025 and 2026. The unemployment rate is expected to improve slightly, dropping from 6.2% in 2024 to 6.0% by 2026. Asset quality is expected to normalize, with gross impaired loans ratios trending higher. For the second quarter of 2024, the average gross impaired loans ratio was 0.64%, up from 0.59% in the previous quarter and 0.43% a year ago. However, it is not expected to sustainably exceed 1%. The high-rate environment may result in continued softness for consumer loans, especially credit cards and unsecured loans. However, residential mortgage loans are performing well due to low loan-to-values, stable employment levels, and a housing shortage. Despite increased loan loss provisions, profitability remains stable as banks have improved efficiency through cost controls. Strong revenue performance in domestic banking, capital markets, and asset management has offset higher provisions and slowing loan performance. Fitch also noted positive trajectories in liquidity and capital buffers. The average liquidity coverage ratio was 135% in the second quarter of 2024, up from 130% in the fourth quarter of 2022. Most banks ended the second quarter with Common Equity Tier 1 ratios above 13%, except for Royal Bank of Canada at 12.8%. Currently, the Bank of Nova Scotia, Canadian Imperial Bank of Commerce, Toronto Dominion Bank, and Royal Bank of Canada have a ZAX rank of 3, which means hold, while the Bank of Montreal has a ZAX rank of 5, which means strong sell. Now, let's shift our focus to the financial markets. Equifax Incorporated stock underperformed on Monday when compared to some of its competitors, despite experiencing daily gains. Shares of Equifax Incorporated inched up by 0.25% to close at $240.33. This rise came in a mixed trading session for the stock market. The Dow Jones Industrial Average rose by 0.67% to 39,411.21, while the S&P 500 index fell by 0.31% to 5,447.87. Equifax's stock rise did manage to snap a two-day losing streak, but it still closed 34.77 short of its 52-week high of 275.10, which was reached on February 29th. When compared to some of its competitors, Equifax demonstrated a mixed performance. S&P Global Incorporated rose by 1.31% to 444.97. Moody's Corporation increased by 0.89% to 425.64. And Fortinet Incorporated fell by 0.48% to $58.28. Despite the gains, Equifax's performance lagged behind S&P Global and Moody's, which saw more significant rises. The stock market's mixed performance on Monday highlights the volatility and unpredictability that investors are currently navigating. While Equifax managed to post gains, Its underperformance compared to key competitors like S&P Global and Moody's indicates that there are still challenges ahead for the company. Investors will be closely watching how Equifax navigates these market conditions moving forward. That wraps up our episode for today. Thank you for joining us on the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's discussions on the housing market, affordable regions in Ontario, Canadian bank ratings, and Equifax's stock performance insightful. I am your host, Steve Hamoan, and we look forward to bringing you more updates and expert insights in our next episode. Until then, stay informed and make well-informed decisions. Goodbye.